This growth ETF is up 306% since it first launched in 2015. The numbers are remarkable, so I figured it's time we talk about it on the channel. Welcome back, guys. My name is Spencer, and on this channel I talk all about ETFs with growth factors and sometimes even a little bit of dividend stock investing. Now, ticker SPMO is the ticker of the day. Very popular. It's a really interesting, different type of ETF that I think you're going to want to know about. So what we're going to find out is exactly how much money would you have over 10, 20, 30 years if you invested $10,000 today and it traded sideways, just how it has been trading. As always, if you're interested in ETFs, in stocks, in dividends, you are in the right place. Don't forget to like the video and to subscribe so you never miss an update. Let's roll that intro. Ticker SPMO is owned and operated by Invesco, which is the same company that runs ticker QQQ and QQQM, two of my all-time favorite growth ETFs, and the record of those ETFs is phenomenal. So I'm very, very interested right off the bat. But we need to look at it further out. If we go to 1 year, it's up 26.5%, which is phenomenal. 5 years, up 148%, and max, like I said, 306%. Which is phenomenal. Absolutely skyrocketing recently. Now, I will say this is a different style of ETF than I've ever seen before. I have not seen one like this by any means. So we're going to jump into their website and check out what I mean by that. Why is this different and why does it seem to be working so well? Using Invesco's website, we can find everything we need to know about SPMO. So we can see the product details, and what makes this thing unique is in here as well. The Invesco S&P 500 Momentum ETF is based on the S&P 500 Momentum Index, meaning the fund will generally invest at least 90% of its total assets in the securities that comprise the index. The index tracks the performance of the stocks in the S&P 500 index that have the highest momentum score. The fund and index are reconstituted and rebalanced twice a year on the third Fridays of March and September. Constituents are weighed by their market cap and by their momentum score. So the momentum score is really, really interesting. And what they're tracking is popular stocks. Whether or not you think the stock has the best PE ratio or the best value, that is not the goal. The goal is basically hype. Everything that's super popular. So when you're looking at right now, things like PLTR, things like Tesla, on and off. Sometimes it's really popular, sometimes it's not. For a long time, Nvidia was extremely popular. So we're going to go through the portfolio a little bit, but that's how this runs. It basically runs off of the hype of the market, a lot of which has to do with retail investors. Another key part of SPMO is the yield. It's low. We've seen it actually at as low as 0.5%, but they do state that the distribution rate based on the last dividend is about 0.7 to 0.8%. Not bad. Nothing to write home about, but it will make a difference with compounding and growth in the long run. The next thing we always talk about with these ETFs is the expense ratio and the management fee, which is 0.13%, meaning that's the cost of owning this ETF. Now, that's higher than some that we've seen like VOO. That's really low at like 0.03, but I always say you do get what you pay for somewhat. Sometimes not enough, but with this, I do think SPMO is worth that. It's still a very low expense ratio. Moving over into the performance category, you can find all this data on your own, by the way. Go to their website, check these things out. But we're going to go down to the growth of $10,000. And this shows the difference between the S&P 500 Momentum ETF, the S&P 500 Index, and the S&P 500 Momentum Index. So the ETF has just barely underperformed the S&P 500 Momentum Index. And I'm guessing that this is not including the dividend, because I doubt the S&P 500 Momentum Index pays a dividend, although I could be wrong. So really close, but both are significantly outperforming the S&P 500 Index, which I think is really, really important. Now, into the portfolio. You always want to know where your money is going and make sure you are diversified. So large cap is about 19%, large cap blended is about 35%, large cap growth 33%, and so on and so forth. It dwindles down. The main couple of categories: information technology, not surprised there, financials 20% and 21% between financials and information technology. And then consumer discretionary, 16%, communication services, 14%. So it really is in a lot of things, actually, which I like. I like that it's well diversified, but it has these, I would say, highly profitable sectors that are booming and growing at the top. And that, of course, is the goal. And then, consumer staples, some of which I like more than others. You can see the top holdings: Nvidia, Amazon, Meta, Broadcom, Tesla, JP Morgan, Walmart, Netflix, Cost, PLTR. So the ones I already mentioned are already on here: Nvidia and PLTR. And that's how these trade, which is so interesting to me. And I never really thought about this as an idea, trading off more momentum and hype rather than just fundamentals, but it seems to be working. Let's check out the dividend history and see if it pays out anything worth it, if we should even factor it into our calculation. Because this is not a dividend-focused ETF, they're all over the place, as expected. We have a high of 34 cents and a low of 7 cents, and it does pay out quarterly. So that's pretty crazy, jumping all over the place, but we can't really complain. It has been paying for a long time, only missing 1 year of dividends, or 1/4 of dividends, I should say. When we go over to the dividend scorecard, this is going to show us that it's a low yield and it's a low growth rate. It's actually dropping over time, which is not what you want, but that's okay. The dividend growth rate is a factor more so for dividend growth stocks and ETFs, not so much just specific growth ETFs. Yes, the dividends are a bonus, but they're not why we're investing, right? We're investing for the growth. And again, that yield of 0.49%. So that's what we're going to use in our calculation. But first, we need to check the DRIP calculator and let's see how much money we would have made over the last decade had we invested into SPMO. Throwing it into the dividend reinvestment calculator, we can see that SPMO, had you invested $10,000 into it initially, it would now be worth $45,700 after 9.5 years. Quite a good amount of growth. Total return 357%. Annually, that's 17.13%. That's with dividend reinvestment on. With DRIP not on, you are still getting a crazy return of 329% and an average annual total return of 16.4%. Still beating the market average, I will say. And your $10,000 is now worth just under $43,000. So not a crazy difference, but definitely a difference we want to note when we're thinking about DRIP versus not dripping. And again, I'm a fan of SPMO. I don't own it yet. It's definitely on my list now. And I'm curious what you guys think about it. Is this one you guys own? Is it one you're buying, one you've been researching? Let me know. You must have some interest if you've watched the video to this point. And I'm curious, are we all on this one together? What do we think? Because I am doing a challenge where I invest $5,000 into some of the top growth and dividend growth ETFs, and maybe SPMO should be in there. Let me know what you think in the comments, and let's do our $10,000 invested calculation. Everything is plugged in. We have 97 shares at $103 per share. We're not adding anything annually, and our no dividend taxes, no taxes at all, because I'm not going to factor it in. Everyone's taxed differently, so if you know how much you're taxed, like your tax rate, factor that in for yourself. Then we can also see the distributions quarterly. DRIP is on, but the dividend won't make that much of a difference because it's very low, 0.52%. And our expected annual share price appreciation is 17.13% per year. That's based off the DRIP calculator. Now, if you think that's too high, it's very high. But that's the 10-year history of what we've seen from SPMO. So it's already done this for 10 years. It could do it for another 10, another 20, even 30, potentially. But again, all of this is assumptive. So we don't know what the stock market's going to do. We don't know what SPMO is going to do. So again, it's all educational and informative, but we're not actually predicting what it will do. Chances are it'll do whatever it wants to. So after 1 year, we can see our 10K is now worth $11,800, which is solid, 17.65% return. We love to see it. After 5 years, it's going to kick up very quickly. After 5 years, your 10K is now worth $22,000. And we have a total return of 124%. We'll love to see it. Now we're going to keep going because 10 years is going to do us a lot of good as well. After 10 years, we've now almost 5x'd our money. 10K to almost $50,000 for a 400% total return. Phenomenal. We've also made $500 in dividends. Again, not a lot, but worth noting. $500 isn't just chump change, in my opinion. After 20 years, our 10K is now worth $243,000 for a 2,332% return. And again, this is aggressive, but it's not impossible. It's definitely doable. We've seen the fund absolutely trend upward. We've seen it return great returns every single year, and it could continue to do so. Nobody knows. Let me know in the comments if you think it will or won't. I'm curious, again, as to what you guys are investing in, if we like SPMO. But all in all, solid for 20 years. Now we're going to kick it up to 30 years. But before we do that, I do want to say, if you're interested in ETFs, in growth, in dividends even, Don't forget to like and subscribe. Helps out the channel. We're almost to 1,000 subscribers, which is just amazing. Okay, 30 years. I like to use the idea of, let's say we're 30 years old, we invest 10K in a Roth IRA, so we're tax exempt, into SPMO, and we let it trade for 30 years because, hey, near retirement, we want some extra money. Now, we're hopefully not going to retire just on this because it's not going to be enough to sustain us with inflation, I imagine. But I like saying, oh, maybe we want to take some vacations, buy an extra property. Who knows? But 30 years out, how much money would we have and what can we do with it? So after 30 years of investing at SPMO, where it pays a 0.52% dividend at a rate of 17.13% share price appreciation every single year, you would have, after 3 decades, 10K would be worth $1.18 million. This is crazy. That actually blew my mind. It's more than I thought. I haven't gotten to this portion of the calculation. That is wild for a near 12,000% total return. And the key with this is its consistency. That's amazing. So you definitely, I don't know if you could retire on 1.2 million in 30 years with inflation, like I said, but it's better than someone that has nothing in retirement. And at this day and age, if you had 1.2 million, you'd be able to do a lot. Definitely a lot. I imagine you could retire even at 60 and live a pretty nice life for quite a while just making those dividends. Love to see it. Now, I like to kick it up. Let's say you want to go till 65, or you were 25 and you invested and you wanted to retire at 60. If we go to 35, how crazy does this number jump? From 1.18 million to $2.6 million, just a 5-year difference. Absolutely doubles your money. That is insane. More than doubles. That is crazy. And that's the power of compounding and the power of consistent returns. So I hope you guys enjoyed this video breakdown on ticker SPMO. Again, don't forget to like and subscribe. Drop me a comment. And if you enjoyed this video, I guarantee you're going to like these popping up on your screen right now, especially this one on SCHD and its insane potential with 10K invested. Thank you guys so much for watching. I hope to see you in the next video.